Offering close to 4% of dividend, this company might be the next big thing in the transportation field, especially with the aging of the global population that is predicted for the next couple of years. Today, I'll share with you my full stock analysis on Savaria stock with the ticker SIS. As always, I'll start with analyzing what is their business model of the company, so how are they able to generate their income and who are their different clients. And after, I'll make a quick fundamental analysis followed by a price prediction for this company to see if it is currently over or undervalued. So let's get to it right now. Savaria is a Canadian construction company created in 1979, and it is designing, manufacturing, installing and delivering different accessibility equipments. The company's main products notably includes stair lifts, wheelchair lifts, home elevators, and commercial elevators. At the moment, this company isn't really known by many investors, as we can see with its small market capitalization of less than $1 billion and by its past revenue in 2021 of about $660 million. However, with the aging of the global population, the business model of this company will be very interesting to keep an eye on for the next couple of years. Indeed, as we can see here in Canada, but also in the world in general, about 1/6 of the global population will be 60 years old or more in 2030. And between 2020 and 2050, we should see 3 times more people aged between 80 years old or more. And when I'm talking about old people, what is the first thought that comes to your mind? Well, for me personally, I'm seeing old people that have a lot of difficulties to transport themselves from one place to another. And it's there that Savaria will be very interesting, especially for them. As being a global leader in the mobility sector, the different products and services from Savaria have the objective to help people to maintain their great mobility. It can be at their home, in public services, or even in their car. They notably have many different kinds of products such as home elevator, through the floor lift, incline lift, straight stair lift, curved stair lift, and vertical platform lift. But most importantly, in my personal opinion, they have great accessories for cars. They notably have lowered floor designs to help people to enter in their car, but obviously most of those products are not necessarily very affordable for most of the population, as we can see with the price of home elevator that goes from $20,000 to more than $35,000. But for the future, it could definitely be very convenient for most of the people that need it. And with the population that is getting older and older, we can expect to see a massive boom in this industry over the next couple of decades. And Savaria on its side is giving some great incentive to encourage different investors to invest in their company, as we can see with their monthly dividend yield of close to 4% at the moment. However, over the last couple of years, we've seen that the value of this company has fluctuated a lot. For example, during the pandemic, it has gained some massive valuation, but we've seen that 2022 has been a pretty rough year for them because of the global economic conditions, especially with the rise of the interest rates. This has impacted massively Savaria that currently has a lot of debt, and at the moment the cash flow that they are generating are not able to cover their debt, which means that they also have some difficulties with their payout ratio for the dividends. But despite all of those bad news, we've saw recently that with all the different earnings of this company in 2022, those bad news haven't necessarily affected negatively the financial performance of this company. And if you follow my monthly series on my portfolio update, you must know that I am currently invested in Savaria. Personally, I've bought my first position in this company in June 2020, and since that point, except for 2022, it has been a pretty good company for me, especially with the great cash flow that they are giving me from their dividends. But now, let's see if this company is currently worth your money. In valuation terms, we can see that this company currently worth about $950 million. However, with a pretty high price to earning ratio of about 38, which would mean that on that side, this stock would currently be overvalued. And over the last 12 months, we can see that they haven't been able to generate some high profit and operating margin, as well as a pretty average return on equity of about 5.72%. But over that same period, we can see that they have been able to generate over $766 million of revenue, with a great increase of about 11% in their quarterly revenue, and a massive increase of more than 122% in their quarterly earning growth. But what is the most shocking with this company is the number of cash, about $50 million that they have compared to their massive debt of over $444 million. And for the risk of this company represents by the beta on a 5 years period, we can see that this company would be slightly less volatile with a beta of about 0.76 compared to the overall market. But despite that, we can see that on the 52 weeks change of the valuation of this company, it has still lost about 19% compared to only 12% for the overall market. And as I told you earlier, they are giving a great annual dividend yield of about 3.51% that is paid at each month. But the problem is that with their massive debt, their payout ratio is super high, even higher than 100%, which might represent some kind of problems for this company that might be forced to cut it if they want to keep a sustainable dividend on the long term. And over the last 4 years, we can see that there has been some great increase in their total revenue, but we can also see that the cost of revenue and the operating expenses have also boomed during that period, which have obviously been reflected in their net income progression over the last 4 years. And despite a great increase in their cash flow from operating activities over the last 4 years, we can notice that their cash flow from investing activities as well as their cash flow from financing activities have been diminishing, which has led to a slight reduction in their free cash flow. Now let's take a look at what is the current intrinsic value of Savaria. And as always, to start, I'll be using the Peter Lynch valuation method, where you will come add the future growth of the earnings per share with the dividend yield that you will come divide by the price to earning ratio. And with those indicators, we can see that the current results mean that this stock would currently be overvalued. Unfortunately, with the dividend discounted model, we won't be able to use it in that case, since as you can see, the average growth rate is currently bigger than what is the weighted average cost of capital for this company. And talking about the weighted average cost of capital, I'll be using the discounted cash flow as my third method, where I'll be simply discounting the different cash flow of this company to find what is the true value of this business, but started to, as always, by calculating what is the cost of debt with the cost of equity and the cost of debt and equity, which is giving you your weighted average cost of capital. And with all of those criteria, we find that the intrinsic value of this company is about $13.74. And considering the current price, we could see that this company would currently be overvalued at the moment. As you've been able to see in this video, Savaria has a great business model that has a lot of potential for the next couple of years, especially with the aging of the population that might need some help with their mobility. However, the financial metrics are not showing that at the moment this stock would be undervalued, notably because they currently have a lot of debt that comes affect their financial health. But in my personal case, since the stock is currently down of close to 20% over the last year, well, I might be tempted to add some shares to my own portfolio over the next couple of weeks and months. But on your side, if you want to find what could be the future in the renewable energy sector, well, check out the video that's gonna be right over here on Algonquin stock, and I will see you soon. Peace!